Hi, I'm Mr. Simons, and in this video we're going to talk about flows, but we're not talking about lyrical flows and who's got the best rap flow. Instead, we're going to be talking about financial flow, the movement of money around the world. Let's get into it. Okay, before we get stuck into financial flows, let's start by distinguishing between trade flows and financial flows, an important distinction. Now, trade flows is all about the movement of goods and services around the globe, and it is really important to think about goods and services. So those are trade flows. Now, if we move to financial flows, instead of looking at the movement of goods and services, we're looking at the movement of money. And if we're looking at that movement of money, we can be thinking about things, okay, money might be moving to invest in particular projects. It might be moving for speculation to make that short-term quick profit. For investors. When we talk about financial flows, it's very important to distinguish between two separate types of investment. There is what's called direct investment or foreign direct investment and portfolio investment. So foreign direct investment, FDI, is a particular type of financial flow. Remember, that's what we're talking about in this section. And foreign direct investment has these characteristics. So foreign direct investment has these characteristics. It's long-term. Investors are putting their money down for a long-term gain, not for some kind of quick payoff. That the investor, so the person moving their money internationally, wants input into decision making. They don't want to sit on the sidelines and let someone else take total control. They want some input. So foreign direct investment could also be a controlling stake where the investor owns the majority of shares and kind of essentially runs that business. And FDI can also take the form of buying existing businesses or setting up a new one. So when we're talking about FDI, we can have these two possible situations. One is the investor comes in and sets up a new business. That's foreign direct investment. The other option is that an investor comes in and purchases 10%. The other option is the investor comes in and purchases greater than 10%. So purchases more than 10% of the shares on offer in an existing business. That is also considered foreign direct investment, FDI. Foreign direct investment, FDI. So now we're looking at portfolio investment. And remember, we're still looking at the idea of financial flows. This is just a different type of money moving around to FDI. So portfolio investment is more short-term than FDI. They're not looking to stick around for a long time in terms of creating or running a business. That investors take smaller, non-controlling shareholdings, so typically less than 10% of the shares on offer. That the investor is not seeking ownership or control in the business. Portfolio investment could also involve investors seeking a quicker return than FDI, potentially, just trying to make a quick profit or a quicker profit than with FDI. The easy way to think about it, I think, is that portfolio investment signals to me it's kind of like part of your portfolio of investments. You got a little bit here, a little bit there, nothing huge in any one business. And that's the nature of portfolio investment. We're going to apply this idea of financial flows, particularly to Australia. And what we say about Australia is that Australia is what's known as a net capital importer. So in this context, when we talk about capital, we're talking about We're not talking about capital goods in this context. So let's unpack this term. So if we separate these terms out, that if we talk about net, we mean overall. Capital, as I mentioned before, we talk about money. And importer, we're talking about bringing it into the country. So what we're saying with net capital importer is this. What we mean is that Australia brings in more financial flows than it gives to other countries. So let's use a bit more specific language here. When we say Australia brings in, what we mean is that Australia imports more financial flows than it gives exports to other countries. So Australia needs more money coming in than it can lend to other countries. So what we can say is this. So what we can say is that Australia has the shortage of investable funds, funds that can be invested in particular projects. As a result, Australia needs to bring in capital from overseas, and that makes it a net capital importer. So Australia has a shortage of capital, a shortage of funds for investment, and it needs that from overseas. So we might then think about, well, why does this occur in Australia? So there are two particular reasons we can think about. The first reason here is that Australia has a relatively low level of domestic savings. So this means that there's not a pool of savings that can then be used for investment. So Australia lacks a sizable pool of domestic saving, remember S is for saving, to fund investment, I for investment. And this goes back to household savings rates and the ability of households to create savings that can be used for investment projects. So this means that Australia has to look elsewhere to get those savings. The second reason that Australia is a net capital importer is because of something called the savings investment gap, or the SI gap. And what it basically means, it's related to point one, basically that Australia's investment needs are greater than its level of domestic savings. So as a result, to fill this savings investment gap, Australia needs to source capital, money, finance from overseas. It needs to bring in financial flows. Okay, so this was all about Australia's financial flows. Remember, not the same as trade flows or wrap flows. It's about the movement of money. Thanks for watching. Any questions, leave them in the comments and make sure to come back for some more high quality economics content.